So we're in Mosler at the end. And so, oh, all right then. So keep it to about 15 minutes, okay, and I'll let you know when time is up.
You may, yes. Yes. Absolutely. And then, here's page 1, page 2, just not staying. Get it. Here's page. Should I start? Okay, so hi, my name is Mike Murray. I'm from Bemidji State University. Well, first off, a little bit of shameless self-promotion. A couple years ago, I was asked to become the editor of the American Review of Political Economy. It's a online journal, open access, and I just had our print shop at Bemidji State print off a bunch of copies so I can hand them out. So they were on the table. So maybe some of you got them. But this is our relaunched issue, and then we also published the ICAPE proceedings, and that one's going to come out as soon as I get back to Bemidji and can put it on the server. So, and Jeff Schneider wrote the introduction to that one, so it's pretty good. So if you're looking for another outlet for your research, American Review of Political Economy, check us out. So thank you. So what I did in this paper, and I don't really have a presentation, I just thought printing out the model and handing it out would be best, and I apologize if I didn't make enough copies. Usually my sessions aren't this popular. So what we're looking at here is we're integrating how capital moves through production, and I'm using Adolf Lowe's post-classical production model that's in his Path of Economic Growth. A lot of people may not have heard of Adolf Lowe. Adolf Lowe was a dissertation advisor of Robert Heilbronner, who was a dissertation advisor of Matt Forstater, who was a dissertation advisor of me. So I learned that from Matt. And he's really the only one who teaches Lowe's production theory, I think, anymore. But it's super awesome. And what Adolf Lowe's model does is so if you think of the Schraffian model, which is a circular production, right? What Adolf Lowe's model does is it combines circular production that we see in Schraffa with sequential production that we would see in like the Neo-Austrians like Hicks or whatever. So Lowe was not happy with either circular approach or the vertical approach, and he combined both. And then, so that's what's represented on the first page here. It's just Lowe's production model without money. What I did was I added money into it. So he has 3 sectors which go into 4 stages. So it's kind of easier if you just look at the 4 stages. In stage, that K1, 4, that K1, 4 all the way down there, those are machine tools at each of those 4 stages. So what we have here looking first is we have machine tools plus labor plus natural resources, and that gives you extracted machinery. Second stage, you have machine tools plus labor plus natural resource gets you blast furnaces. Machine tools, labor, natural resources, steel mills. Machine tools, labor, natural resources, and that gets you machine tools. And then machine tools are then used again at the 4th step of stage 4. Machine tools are used to make that output. So we see that machine tools are circular production. It is used back in subsector 1 there, which makes so subsector 1 doesn't make intermediate capital goods, but they make the capital goods before you can make intermediate capital goods, like extract machinery, blast furnaces, whatever, right? The stuff you need to make intermediate inputs. Those machine tools become what Schraffa has termed a basic good, right? And then when you look at subsector 4 there, you have K21, right? So that's extracting machinery, plus labor and natural resources which make you iron ore. And then at sub D, or that second one, you have K22, which is your blast furnaces. Those blast furnaces plus your iron ore from the previous stage in sub D4. So your blast furnaces from subsector 1 and your iron ore from the previous stage get combined with capital and labor to produce pig iron. Likewise, your steel mills plus your pig iron plus capital and labor is used to make steel. And then your machine tools plus your steel is used to make intermediate outputs, which here is cotton gin, spindles, looms, sewing machines. Eventually, we're going to make a dress. And then at the end here, sub D4, you have your cotton gin, which is combined with capital and labor to make cotton. And then you have the second one here, you got spindles, which combines with cotton to make yarn. And then you have looms, which combines with yarn to make cloth. And then you have the sewing machines from the previous stage or the previous sector combined with cloth to make a dress. So we have sequential stages of production here. But what this looks at and what Lowe is concerned about is looking at structural bottlenecks, right? So you can have a global bottleneck here with machine tools, right? If you don't have machine tools, you don't have anything, right? But if you don't have yarn, then you just don't have cloth in a dress, right? So you can have local bottlenecks or you can have a global bottleneck, and the timing of production becomes really important. Now, what I've, and there's also capital specificity in this model as well. So, and I talked about horizontal and vertical. Now, what I did was I said, okay, you can't just have this stuff, these intermediate goods, they need to be purchased, right? But the price, so if you look at sequential natures of production and the role of finance, they need to be purchased. So before any production can take place, you need the demand and extension of credit, right? And then you need the buildup of capital stock and the hiring of employees, right? And then you can produce those intermediate outputs for sale. And then at the next stage, at the next sequential stage, like let's say they produce cotton, but at the next sequential stage, you need to have the financing for the purchase of that cotton in the yarn sector, right? So, and you also need the financing for the sewing machine, right? To produce, or I guess it'd be looms, right? To produce the yarn, right? So you need that capital financing first. So the demand for credit comes first at all stages of production. So what I'm thinking here is what Lowe was thinking about physical structural bottlenecks, either global or local. I was thinking, hey, if you need banking, if you need the demand for credit and extension of credit to come before all of this, well then the banking sector can say no, right? That was in Keynes, right? Keynes said that you need the bankers and the investors have to agree, right, before capital comes about. So you need the demand extension of credit, you need the build up capital stock, you need the production of output, payment of wages, and then you finally get the production of that final consumer good, the dress. So now on that second page here, then we got to think of, well, what's the cost of capital? Well, the cost of capital isn't the cost of a machine. Right? If I want to build a Starbucks, I don't pay for the entire store first. No, I go to the bank and I get a loan, and I have to pay on that loan, and that becomes part of my cost structure, is that payment, right? So we have here, this is just your typical, time value of money payment formula, right? So what we can do then is we can monetize that model, and you see that we need to have the extension of credit, and then that payment is the cost in that first stage, and then you have wages paid, price of natural resources, which gives you the price of extracting machinery, and then you have that second stage. You need to get a loan for that extracted machinery, and then you have the cost of wages and things like that going all the way through. And by monetizing this model, you can clearly see that, well, first off, the price of intermediate goods in terms of its cost, right? You just have a portion of that those capital costs reflected in the price of that good, right? But then we see that we need the banking sector at every stage of production here. They need to approve it, right? In order for production of the dress to take place. And then, right, so then you have this all the way through to the production of a dress. So some features of this model, I already talked about Keynes's investment theory. I already said you got this demand for credit, which yields capital investment, which then yields the hiring of workers, the payment of wages, which then yields the production of capital, which then yields increase in output. And then if you're familiar with Ed Nell's model, right? Ed Nell has this two-sector model, and we see that the price of capital, the price of the capital goods the output of the consumption goods is equal to the summation of capital and wages and so on and so forth. So you can look at that a little further. Now, when we think about growth, we have to look at how capital flows, because you just need to build up the capital stock in the first period. But after that, capital stock depreciates, right? And you need to pay for that worn out capital, whether it be maintenance or whatever, right? So then so this is time zero. What I just talked about was time zero. At time t, you get what's on the back page here. And in the interest of time, I'll just skip to the back page. Assume g is equal to 0 for now, because Matt. So assume g is equal to 0 for now, just because it makes life easier. Here's page 1. So what we got here is after the first period, well, you still need to pay for those capital stocks until whatever the maturity of the loan, right? So and then this FTR, right? This is the payment or the price of the working capital or the circulating capital that gets used up in production, right? So you need to pay for that at each stage of production, and we see that. Well, this is one. Let's go to sub D2. It's a little easier to think about, right? So if you look at that, the pig iron sector, assume G is 0. You need the payment of your loan or whatever from the capital acquisition in period 0, plus you need to pay for the working output, right? From the which is the payment for the iron ore, which is here. So that cost is going to be equal to that revenue, right? Because these people sell iron ore to the pig iron sector. So that's why I put that here. Then you got the payment of wages, and then you got that equals the total price of pig iron, and then you can think about that as being P times 1 plus the rate of profit times however much output is produced. So you can think about the rate of profit then is simply a markup above cost, right? Because we have the payment for that capital stock already reflected in the cost of production, right? So literally profits are a markup, right? Profits don't, right? I mean, profits are revenue minus costs, right? In this way, profits don't finance, or profits don't pay back. Profits don't pay back the extension of credit. No, the price of the product pays back. Once you sell your product, you pay back your loan. Profits are a markup above costs, right? So we really have administered price theory here. Now, what we see then, if we're going to have a growing economy, good. If we have a growing economy, let's say that the economy grows at 2%, which I wrote this wrong on my paper. I apologize about that. If G is equal to the rate of profit, then you don't need external financing in order to move the economy along. However, oh, by the way, this doesn't assume full employment. This is a given level of employment, right? This is equilibrium employment. This might not be full employment, right? And you might not get full employment because it's just a private sector economy. Bankers and investors are not interested. It's not their prerogative to move the economy to full employment, right? So if you need a 5% rate of growth for full employment and the economy is ticking at 2%, well then you have a 3%, right? You got a 3% gap there, right? And that could be caused because either investors don't want to grow the economy at 5%, or bankers say, no, we're not going to grow the economy at 5%. We're only going to grow it at 2%, right? And the only way the economy can grow at 5% is if they have a profit rate or a markup of that, which is not really reasonable. So then we can also kind of think about how since I'm kind of out of time here, if we can think about how the job guarantee fits into this, right? Since you need both bankers and investors in order for capital acquisition, or even if the time horizon is bad, right? Because you can have a local bottleneck because it's a sequential nature of production. So if you have a hiccup at like the cotton sector, then everything else is not getting done for whatever reason, right? So then this allows for the option of having, maybe we need some other sector in the economy that's not dependent on the banking sector for the acquisition of capital, and Eric's going like this, and who doesn't sell their output and therefore doesn't need to yield a return in order for growth. So anyway, that's the nitty-gritty of it. Thanks.
Excuse me, may I ask a quick question?
Yeah.
What are the indices in your model, linear model? What are the indices in your linear model?
Oh, the indices? Sorry. Those are the I would be the sector, so the capital sectors, or the intermediate sector, or the final goods sector, and then the J would be the stage within each sector. Yeah, sorry, I apologize.
All right, no problem. Just work out the equipment first. Right. Now go back. Okay, I'm Martin Watts from the University of Newcastle in New South Wales. This paper is picking up on a debate that was in the literature back in 2007 and was also picked up in the quite antagonistic debates between certain people who call themselves post-Keynesians and modern monetary theorists, instigated by Tom Pally in an earlier working paper and then a journal article.
Which one is he?
Which one is he?
Post-Keynesian or modern monetary? Which side of the arguments?
Yes, thank you. For a little clarity, I should point out, Tom calls himself a post-Keynesian. I think even that's in dispute. He is not sympathetic, for whatever reason, to MMT. Eric here and Randy responded, and there have been other responses since, including John Smithen. I wanted to sort of get into this debate without more or less repeating what Eric and Randy had talked about. And I got some sort of leverage from this paper by John Smithen. And the particular debate I want to focus on is interest rate policy. And countries vary, of course, in their interest rate policy. There are a number of countries that inflation target. Some countries don't specifically inflation target, but when they feel that when the central bank feels that the inflation rate is going to rise, then they may well raise interest rates. The
argument on the part of some MMTers is that the policy rate, the rate that the central bank sets every month, should be fixed at 0. And of course we've had experience of 0 target rates in this country and in Japan. Now the rates now started creeping up. Now, Smithin argues that a fixed nominal rate, it doesn't have to be 0, leads to an unstable inflationary process. But on the other hand, if you have a fixed real rate, so in other words, the nominal rate minus some measure of the rate of inflation, then you get a stable inflationary process. In a conference paper last year, I showed that his claim about the stability of the stable repercussions of a fixed real rate was false. In fact, if you do the analytics properly, it's unstable. So he came back with a further paper in ROPE, the Review of Political Economy, coming up with a different real rate rule. So it's not actually a fixed real rate. It is a rule for the rate, which is linked to the rate of inflation. In other words, it's inflation targeting. And I've worked out in the interim that this doesn't necessarily lead to a stable inflationary process either. Now, back in 2007, there was a series of papers in the Journal of Political Economy, Journal of Post-Keynesian Economics, including a paper by Randy, Rochon, Setterfield, and others. And Rochon and Setterfield, to their credit, are actually fairly even-handed in their work, and they look at the merits of fixed real rate, fixed nominal rate, and also what they call the fair interest rate, which I'm not going to talk about in this presentation. And what they try to do is to model the impact of these different interest rate policies on inflation, but also on the real economy. And I thought, having worked out that John Smithin's latest real rate version wasn't stable either, I would have a look at Rochon and Setterfield to see what they got up to. Now, the other part of the paper, which I won't spend much time on, is that if you have an essentially passive interest rate policy, whether it's a fixed real rate or a fixed nominal rate, then you're not really using interest rate policy to guide the economy in any specific way, and therefore that raises the question of what policy mechanism you're going to use, and obviously active fiscal policy is appropriate. So that's a very brief outline of what I'm going to do, and I think I better get on with it. Now, why do we want a fixed nominal rate which is very low, or a fixed real rate which is very low? Here is a series of arguments put forward by another participant in the debate, another Australian, albeit of Greek origin, Aspromorgis. Tony Aspromorgis is at the University of Sydney. Now, I won't read all those out, but you can see there are some strong arguments for having a low interest rate policy, or so-called cheap money. So certainly the idea is it does stimulate the economy. And I mean, part of the argument is that monetary policy doesn't work anyway, as it's currently conducted. Now, there's some support for a central bank interest rate reaction function, which comes from post-Keynesians. But of course, as I say, the argument that monetary policy works is incredibly dubious. And you can look at papers pre the global financial crisis, Bank of England, Bettini and Nelson, to see that empirical work's been done and monetary policy is amazingly ineffective. And post GFC, or in the middle of the GFC, Randy's paper in the 2007 issue of the Journal of Post-Keynesian Economics makes the effects of monetary policy are problematic in the sense that there are uncertain lags, and it's even uncertain as to whether they have the desired effect. If you raise rates, the expectation is investment declines and possibly durable consumption. But equally, you've got to think about bondholders who are earning higher returns when interest rates go up. And if they add to their consumption, then the effect on aggregate activity is uncertain. So Rochon and Setterfield argue there is a growing consensus that interest rate policy should be essentially downgraded. And as I say, there are three possible approaches, and no doubt there are others too, and I'm just going to focus on the issue of the fixed real rate versus a fixed nominal rate. Now, John Smithing has a very curious model of money supply and money demand, from which he ultimately generates a inflation equation, which is obviously includes the interest rate. It's curious because all post-Keynesians agree that money is endogenous, and so you cannot talk in terms of an independent demand for money and an independent supply of money. Also, in looking at the properties of the different interest rate policies, he's only concerned with inflation. He's not concerned with the effect on the real economy, albeit possibly there isn't an effect. He does have a pass-through relationship between the policy rate and the market rate, which a number of studies don't even think about, including Rochon and Setterfield. As I say, I showed that his original real interest rate policy didn't lead to a stable inflationary outcome, and also this targeted policy doesn't either.
Martin, that was within his framework?
That was within his framework, yes. It's worth emphasising that. One can argue the model is problematic, but sticking with his framework. So as I say, in the second round, he went on to incorporate a rule. But again, there is the problem that the model doesn't lead to stability of the inflation rate. And in terms of then looking at the model, the model is unstable or potentially unstable. You can also raise questions about pass-through. In other words, if the central bank raises the rate, the central bank raises the rate, the financial institutions tend to follow suit, and they tend to follow suit very quickly. When central bank cuts the rate, the Australian experience over the last 5 years or so is the banks don't cut their rates of a similar magnitude, arguing that wholesale costs of borrowing have gone up. So that's become a fairly consistent pattern. So to argue pass-through is symmetric is problematic, and that leads to all sorts of problems. And even making the argument that there is a link between interest rates and inflation rates, of course, is problematic too. And as I say, he doesn't consider the real economy. Now, I'll leave some of the sort of debates about the merits of a nominal interest rate policy, other than just to point out that Pally argues that it will lead to asset speculation. Asper-Morgus, who's a post-Keynesian, and he's not an MMTer, to give him his due, points out that what we're talking about in terms of the policy rate is the riskless rate. So that's really got nothing to do with asset speculation. And there's a nice quote in the paper about putting up the riskless rate, in other words, the policy rate, to address bad behaviour in terms of asset speculation. So in terms of having a persistent cheap money policy, of course there are ways of addressing the impact on people who are reliant on interest income. Oh yes, there's the reference to bad behaviour from Asper Morgus. There are other ways of addressing asset inflation anyway, asset price inflation, other than by raising interest rates. Now, I want to move on to Rochon and Setterfield's model because I think it's in a way quite interesting. They tried to do some serious modelling here in that they want to have a conflictual model of inflation, which is sort of post-Keynesian thing to do. So the contestation is over the wage share. And there's a target wage share for workers given by WW. I can't remember what the Greek symbol is called. So you've got wage earners who are trying to achieve a higher wage share given by the first term. They're trying to get their wages increased by the rate of productivity, the Q, and also in respect of the expected rate of price inflation. And then firms are fighting over the wage share. They want the wage share lower, and they have a target wage share. And they're also taking account of what's happening to wages, net of labour productivity. So they're fully passing on per unit labour cost increases, W minus Q, but also trying to improve their wage share, in other words, reduce the wage share. And the inflationary process is linked to the real economy by an assumption which is dropped in some of the analytics, which is that the workers' wage share depends on the rate of, desired wage share depends on the rate of growth. And what these guys do is to look at the conditions for steady state equilibrium. So they say, well, we're going to have equilibrium if price expectations are realised, and also the wage share comes into line with what employers want. And in a sense, these guys are doing what Smithin does. They're trying to focus on the steady state without looking at the dynamics. And the dynamics are rather peculiar because we can define the wage share very easily. The wage share is some measure of an average wage multiplied by employment, right, divided by national income. And one can work out the change in the wage share by differentiating that with respect to time, which gives you W minus Q minus P. And you could substitute all that in, and you end up with the expression down there, which is very hard to solve. And I've thought about it, and I've talked to people, and I've yet to work out how to solve it. So the argument that we can build a model on the basis of the steady state outcome seems to me to be rather bizarre. Why have a model which has this conflictual process going on and then essentially drop it? Because what they talk about is that they say, okay, a steady state condition is that W equals WF. So what are firms doing? All they're doing is passing on the increase in per unit labour costs. The wage share stays constant, end of story. And indeed the wage share dynamics, if we work with this inflation equation, are totally independent of workers' desired wage share. Now, I have no time left, so I won't talk about the job guarantee.
I'll do this one right now.
Okay, thank you. Other than to say that Paddy is very hostile to the job guarantee. He seems very confused about the job guarantee. He's concerned about inflation. That was addressed by Eric and Randy. I talk about that a bit further. Pally recognises there's a regime shift when you go from an economy which may or may not have an inverse relationship between inflation and some measure of labour utilisation or underutilisation. When you go from that, the world we live in, so to speak, to a job guarantee full employment state. There is actually a regime shift. You can't just say, well, the Phillips curve, as we call it, or some variant of it, is simply a point. One needs to be aware of the conditions of a job guarantee to talk about what's happening with inflation. What I sort of added to the paper was the issue of framing. Now, Louisa and Bill Mitchell have talked about framing. It's very important. It's framing in respect of language. And I think we can also talk about framing in terms of models. And Pally and others, and this has been mentioned earlier in the conference, have attacked MMT for lack of modelling, which I think is somewhat unfair. His message seems to be, and if you look at his papers, where he criticises MMT, his message seems to be that any theoretical claim, however dubious, gains legitimacy if it's incorporated into a formal model, which is a very curious way to proceed. And I provide some examples of that, which I won't go into, which includes the idea that inflation depends on the growth of the monetary base, which MMTers would totally reject. But he puts it into an inflation equation, and it seems to assume legitimacy. So the quality of modelling is somewhat important, and it is a way of conveying ideas, and sometimes modelling is essential. As I say, Rochon and Setterfield, I don't think do their modelling properly, because they don't, having introduced the dynamics of inflation, they actually suppress the dynamics. Bill Mitchell in a blog pointed out that mathematics is one language to convey ideas, and more accessible language may well be important. And I think a very useful way, as we perhaps all starting to appreciate, particularly when we're talking about key institutions, is balance sheets, which emphasises the stock flow relationship. And finally, a quote from Keynes, which, if you want to cut to the chase, so to speak, you just read the last bit, which is highlighted. So, to conclude, yes, modelling is important, but it's got to be done properly. And given the problematic nature of monetary policy, it's not clear to me how you can satisfactorily model it if you actually don't believe that it affects economic activity, and in turn you're not convinced that it ultimately affects inflation. Now, what you do know, this is my final point, if you keep ramping up the interest rate, like Volcker, like Paul Keating in Australia, you will ultimately shut the economy down. And that's what Keating managed back in the late 80s, early 90s, which was when Australia had its last recession. But working the other way, dropping rates, as we know from the last 10 years, doesn't have much impact. And that's why we've had unconventional monetary policy and all sorts of other nonsense type policies. Thanks very much.
It's a pleasure to be on such a panel with more long-time MMTers than me, especially, have to say Warren Mosler. And it might be sort of funny to be on a panel that's all about interest rates and start my title as interest rates are uninteresting. It's a little provocative. I don't quite mean that there's nothing interesting about interest rates at all, but that one of the reasons that economists are so obsessed with interest rates, which we can sort of put in there, is that they think that it's important for private investment decisions, and that's goes back earlier, but the prime sort of original stone, Rosetta Stone for that argument is VIXL and the natural rate of interest. And so part of this is, there's been many attacks on the natural rate over the years, but I'm trying to hit a very particular one about just where this idea comes from, that it's important in business decision-making policy, and see if that's really the case. Of course, we have to mention a little bit that Keynes, that Keynes, also, General Theory is a difficult book, and there are times in there where he seems like he makes some use of a direct comparison of interest rates and investment decisions. Not to say that he has the natural rate or has the natural rate necessarily in the VIXLian form, but he doesn't clearly and definitively destroy it, as I think most post-Keynesians and MMTers would think that we need to. First, before we get to that, we have to backtrack a little bit and talk about what actually the natural rate is. When you talk to any sort of mainstream economist about the natural rate of interest, the thing they say is, what? You think that if you don't lower interest rates, it's not going to increase demand? And one answer, of course, is Warren's answer, which is no, it's not going to. But the second answer is you've skipped half a dozen steps, and the natural rate is much more than a claim that there's a functional relationship between interest rates and investment decisions. It's an exogenous equilibrium point. It's determined outside of the economy. If you go barely back to the beginning, it's about some barter economy that we can derive that there's some, back then, thousands of years ago, necessary fundamental property that's determined just with the things rather than with money or balance sheets, that an interest rate, that's implied in an interest rate, and that if you hit that interest rate with your monetary interest rate, that you'll finally stabilize the economy. That the time lags, that so an interest rate might actually affect the economy, but you have to know, in order for you to be able to use it as a stabilization tool, you need to know how long it takes to affect the economy. If you're going to lower interest rates, but it's going to increase investment in 5, 7, or 10 years, and you don't know which one, it's very hard to design an interest rate policy in advance that will do that, which is the point I'm going to return to, and that it's a stable equilibrium, that when you hit the equilibrium point, when you finally get to the holy grail, full employment using interest rates, that it's going to stay there, and that it's not going to go at other places. And that this is a much more difficult and stringent set of conditions to defend, and I'd argue that mainstream economists haven't done a good a job at all defending it. And so the key point here is that natural rate is actually just all about the direct impact on the investment decision. We love to talk about the interest income channel. We love to talk about the effect of debt service on households and firms. But to VIXL and to the people following VIXL, the neo-VIXLians, the new Keynesians, all those effects are minor, because the direct effect on the investment decision is so profound that all those are swamped out. And that's one of the reasons they feel like they can be so dismissive of those conversations. And what I'm doing is not going to make any conclusions or strong conclusions about the indirect effects. I can leave that to Warren. But I do want to attack the exogenous, unique, and stable equilibrium on all fronts. So there's a few historical ways to start in terms of the challenge to the direct effects. The first one, and I think the most important one, would be the Oxford Economist Research Group. They, in the 1930s, a bunch of mainstream economists got together and thought maybe we should ask businessmen about how they actually make decisions. It was the first time any mainstream economist had had that brilliant insight, and they decided to do these interviews, and were shocked to discover that imperfect competition models, where you compare marginal cost to marginal revenue in setting your price, was completely irrelevant. And they also, as a secondary part, discovered that it wasn't Hawtrey or Keynes that was right about the effect of the interest rate on investment decisions, whether it was inventories or actual investment, but neither, and that the decisions were mostly irrelevant. The second part is P.W.S. Andrews was the research assistant on that project, so he was taking all the notes and every interview of the businessman, and he got a real first-hand training and became essentially an economic ethnographer, studying this and doing that in his own research, and finding and holding on to all these points and making them stronger and more definitive. I'm going to talk a little bit about A.W.H. Phillips, of Phillips curve fame, and actually that he has something critical to say about monetary policy. And I'm going to jump a little bit into the actual survey evidence of what businesses actually tell us in the last 10, 15 years. So the original Phillips curve paper is nothing like you've necessarily read, but that's sort of a different presentation than mine. He, in general, didn't deny or didn't, directly attack that interest rates have an effect on investment decisions, but he argued that we don't know the time lags, and that's why you can't use it as a major stabilization tool. We just don't know the time lags. He also argued that how much investment then it would cause, we don't know. So if you don't know how much investment spending you're causing, and you don't know when you're causing it, you can't use interest rate policy. Sort of. And that, thus, of course, our conclusion that the fiscal policy is where you go. Then there's the Oxford Economist Research Group. They surveyed interest rates were relevant. The short-term interest rate was completely irrelevant. That's another prime thing, is we move around the short-term interest rate like it's going to affect investment decisions. And even in theory, it's supposed to be the long-term interest rate. And that's why they eventually, finally had the semi-bright idea of doing QE. But even there, we get it. Interest rate is just swamped by everything else. Andrews gets that in his, And then this is the key quote in terms of, he has the essay on the effect in the 1930s on the economics. And he says, when Keynes stood on the real analysis side of the river, we should note that he still gave the rate of interest its classical importance in the sphere of investment decision. This was rather naughty of him, and many have seen it as a puzzling inconsistency. It's a very Britishism. I'm going to do a little bit talking about J.W. Mason before I get into the rest of it. He has a good paper in the JPKE called Loose Money, High Rates. And one of the key points he makes there that isn't emphasized enough is that the way you move interest rates around affects the premium between the risk-free rate, the treasury, and the central bank rates, and the actual rates that private businesses face. And that since the Volcker era, the premiums have gone up because the Volcker era fundamentally changed the psychology of speculators and banks around what they expected to happen in the future interest rates. So we got much higher maturity premiums and much higher credit premiums. And that means that sort of breaks the relationship even just from the private borrowing interest rate from even doing something like QE, which means that even if there was a mechanism to affect investment decisions through their cost of borrowing, we're not doing a very good job of even doing that experiment. And then this is the key point, is that actual businesses don't just, we've been able to ask them, they don't just, take a 10-year treasury bill and say, what's the interest rate on that? I'm going to make my investment decisions based on that. They do all these things that neoclassical business economists have told them to calculate, and they harangue them with surveys every year saying, have you switched to our latest one yet? So the CAPM, the capital asset pricing model, a weighted average cost of capital, internal rate of return. They've come up with 5 or 6 of them. They all sort of suck, and they try to get them to do all of them. And the key point about that, though, is that there's also the cost of capital in terms of issuing equities in there. and so that it's not just simply their cost of borrowing, i.e. the interest rate. The other things that these hurdles are habits. They don't change for 5, 10, 15 years. So, even if you do an interest rate policy and lower long-term rates to 1 or 2, you might not even move the hurdle rate at all. Didn't change in the crisis. This is the key point. We've gotten to the point where JP Morgan and their economists are putting out reports where they're begging businessmen to follow the QE theory. They're saying, why haven't you lowered hurdle rates? The models say you're supposed to lower your hurdle rates. And yes, unfortunately, one of the most vexing aspects of the prolonged low interest rate environment is that record low interest rates have largely not impacted capital allocation policies by means of lower hurdle rates. Basically, QE was bupkis. And then, but it gets even worse than that, is the surveys aren't very good. They don't have actual anthropologists and ethnographics, designing these surveys and pushing them on this. So it's not clear what exactly the hurdle rate is doing. One of the reasons we suspect that a lower hurdle rate might actually generate more investment projects is they have fixed capital budgets. If you're only going to spend $100 million, then lower your hurdle rates, raise your hurdle rates, whatever, you're still just spending $100 million. The biggest thing that predicts a capital budget and how much you're going to spend 1 year is last year's capital budget. They just increase it by 1-2%. And so the hurdle rate is just supposed to be something to discipline managers. If they were just going to do as many investment projects as the hurdle rate said, they wouldn't have a capital budget at all. They would just do as many investment projects, and they would send to the Treasury and say, you got to borrow $20 million more. And then when you finally ask them, the half a dozen or good surveys that are out there, they ask them, and the financial analysis is like 4th or 5th, rated behind where are you going to get your supplies, rated on what is the market context, rated on what is how much capacity, what is the market growth in this sector. It's when you finally get them to ask about whether weighted average cost of capital or any of that stuff matters, they tell you it's basically a sideshow and that it's basically a small disciplining mechanism with managers. So, summing up, qualitative factors dominate investment decisions. Hurdle rates aren't interest rates, don't change often, and are relatively unimportant. We don't need the time lag, but one key thing is that we do need more research. Do need better heterodox informed surveys so that we can get exactly into what the investment decision process is if it isn't interest rates, which I'm arguing it isn't. And that blog being, what do you do with monetary policy if we bury Wixel for good? And that then it becomes all about balance sheet analysis of the kind of things that Mosler would do, which is the perfect way to pass it off to Mosler.
Okay, excellent. Thank you very much. So I've been writing things like this for about 25 years now, and I've yet to have any people like this get up and criticize it like that, so I feel like that's a good thing. Monetary policy in the term structure of prices. You might say now for something really different. This is something I've been thinking about for a couple of years now. I'm tossing it out for you to do the same, and it's certainly in its early stages of development as to what it is and what it means. Flip that ahead. Okay. Oh, I've got this. Good. Thank you. Been replaced by a robot. It's a productivity story. Okay, inflation is academically defined as a continuous increase in the price level. I'm seriously going to ask, is that a fair statement? Okay. So the question is, what does that actually mean, right? And so monetary authorities can't identify, measure, or report the rate of inflation as academically defined. They can't academically identify the price level. They can take a politically determined consumer price index, which is meant for the further purpose of some standard of living for some control group or something, but they can't identify this thing. They can't measure it. Okay, they can report past changes of proxies of the price level. They can say the CPI went up 2% last year, or 2% annually over the last 5 years. Okay, or they can forecast future changes of the price level. They can say we expect CPI to be 1.5 or something over the next year, 5 years or whatever. But they can't tell you right now what is what is inflation, what is the continuous increase in the price level right now. Okay, what is real agents in the economy? What if they want to buy something for today, for tomorrow, for what are they facing? Okay, so what I'm saying is the terms, what I'm going to call the term structure of prices, I'm going to try and make the case, ask if I'm making a case, that this fits the academic definition of inflation. So pricing includes a specified delivery date. And the term structure of prices is a matrix of prices that includes prices for future delivery dates, what you might call the futures markets forward prices, more generically called forward prices. For non-perishable items, okay, the price is a function of the price for immediate delivery plus storage costs. And storage costs include the cost of funds and are thereby a function of rates. Okay, so the term structure of policy rates is the inflation rate as academically defined, given all that. Now, I think I do a little explanatory model here. Okay, so just for this model, we'll assume one item, gold, is produced and there are buyers and sellers of gold. The current price of gold is $1,300 per ounce. Assume a permanent zero rate policy, okay? And we're going to assume no other storage costs for purposes of this little model, okay? The price of gold would be $1,300 per ounce for all future delivery dates. So if you're a jeweler and you wanted to buy gold for delivery today, it would be $1,300. If you wanted to buy gold for delivery from a gold miner for 5 years from now, the price you two would settle on would be $1,300, right? Okay, so, and it's the same for the buyers and the sellers. That would be the indifference prices, would be $1,300 all the way out. And in fact, when you have a 10-year zero rate in Japan, and you look at the price of gold futures in Japan, it's approximately flat all the way out. And the same thing in the United States. If you've got a 2%, 3% 10-year rate, you'll see that gold futures generally go up at a rate of about 3%. Okay? Therefore, in this situation, the rate of inflation, as defined as a continuous change in the price level faced by current buyers and sellers, is 0%. So right now, in Japan, with a zero rate policy, with gold at what price, buyers and sellers going through their daily life, all their business, are looking at, you know, the flat term structure of prices. So you can say that for them, the inflation rate they're building into what they do is zero. It's implicitly zero. Okay. So now we next assume the policy rate shifts to 10%. Now the same people are going to be indifferent on price of gold going up continuously at a 10% annual rate. Okay, so if you're doing business and you're a gold miner, you can say, okay, gold I mine and sell 5 years from now, I'm going to get 10% compounded for 5 years. That's probably close to double. Okay, and so what I'm saying is, academically, by that definition, the way I can read it if I want to read it. I mean, you don't read it any way you want. We are facing a 10% rate of inflation. The policy rate is the inflation rate. Okay. Now, if we look at non-perishables, let's say eggs or something like that, of course you can't store them and use just the interest rate, but if we look at how things are priced in the spot market, whether it's relative value, labor inputs, everything else, you know, you can say in a market economy, anytime one price is set, the rest is going to affect relative value. But we've got enough forward prices being set that are non-perishable, so the perishables, if there's, you know, there'll be some semblance of relative value, pricing them in the forward markets, and so there's that connection. Certain costs will be going up at the interest rate for these direct costs will be going up at the, they'll be facing an increasing term structure of prices for some of their direct costs and indirect costs, as well as just simply relative value. Some of it will be direct, okay? So forward costs of inputs are a function, and forward demand is a function of the term structure of rates as well, right? So we can't lock it in the way we can with non-perishables, but for perishables we can say that in difference levels, if I want to buy eggs from the farmer 5 years from now, he's going to be looking at, in general, what everything else is going to be cost and what his eggs are priced relative to everything else. I'm going to be looking what prices I'm paying relative to everything else, and all these prices that aren't eggs are going up at 10%, and cost of living, and you can imply that a fair price might be the same for eggs as everything else. I'm not saying you will. It'll be a much larger bid-offer spread. The farmer might not want to do that, but if he has to sell and you have to buy, fair value might be right there. Okay, so it's the other thing. Okay, so what I'm saying is monetary policy is about setting the interest rate, right? Term structure of policy rates, whether they're doing it through the overnight rate, through stops on repo, or interest on reserves, however they're doing it, and the term structure of rates through security sales, and sometimes directly, like in Japan where they're targeting. But directly or indirectly, monetary policy sets the term structure of rates, and you can see them trying to fine-tune that when they do quantitative easing, and not that it works, but that's what they're trying to do. Okay? So central bank mandates always include inflation. Central banks labor to understand the channels from their policy tools to their mandates. We just had some very good presentations on that. Do any of these policy tools affect their mandates, which would be what the CPI is going to do, right? Okay, or what output employment is going to do. Okay. Central banks currently have recognized their models are not reliable, so they come to the same conclusions we have here. Okay. I know of no indication that central banks have recognized that the term structure of prices is a direct function of their policy rates. I know they look at futures prices, but I've read the minutes and looked through it. I've never seen them discuss the idea that changing their policy rate will change these futures prices. Okay, they look at such futures price of oil, for example, as an indication in their inflation models, but they don't talk about how their policy rate would do it. I have no indication that central banks have investigated how the term structure of prices per se might influence their mandates. Uh-oh. All right. That's me. Is there another one? That's it. I don't have any more. Okay. Flying blind here. All right. So, no, that's good. So what we have. I'll do the rest without that. So what? 3 minutes? Good. So what? So what I'm saying is, what they're doing, changing interest rates, we know for sure, directly changes the term structure of prices. Directly changes what I call the academic definition of inflation. So their policy tool for what they're voting on is altering the term structure of prices. Now, how the term structure of prices flows through to their other mandates is uncertain. I can't tell you that if they put the rate to 10% and the economy suddenly faces a term structure of prices in their day-to-day dealing of an inflation rate or total, prices increasing continuously at 10%, that means prices will be 10% higher every year for the next year. I'm not saying that. They may go down. But that's not the point. That's not what inflation is. Okay, what is inflation is the question. And I think what inflation is that term structure of prices faced by the economy, real agents buying and selling right now, and not what happened over the last 10 years or what somebody's going to forecast. Those are what they are, but they're not the academic definition. So with all these academics here, I leave the question open.
So we have about let's see, about 20 minutes for questions. So
We sit up here.
yes.
Okay.
Go for it. Yes. You want me
I don't need it unless you. I guess it's.
They record it.
That's fine? Okay.
I think my question is for Nathan, but for others to pitch in, and that's if we do recognize that Volcker, by raising interest rates sky high, was able to choke off the economy and I guess bring inflation more or less under control, certainly reduce inflation. Where there must be some kind of break point in there where, I mean, you would not contend that if, I don't think, or any of you or any of us would contend that if the Fed had, in the face of the Great Recession, had just left the policy rate or even raised it to 5% or something like that, that would have had no effect on the recovery. Surely we think that, oh no, that would have been a terrible thing to do. So there is a point at which higher interest rates are trouble for the economy.
You can take first shot. I will give Warren first
You
shot.
can keep the same response. All right. So what I say is that Volcker's high rates prolonged the inflation. They did not bring the inflation down. It was Jimmy Carter's deregulation of natural gas in 1978 that caused a massive supply shock where U.S. utilities shifted from oil to natural gas. OPEC cut production 15 million barrels a day trying to keep the price up above 30 and failed, and it collapsed. And so I give Carter the credit, and what happened with Volcker's high rates, which he didn't bring down right away, they prolonged the inflation and it dragged on. Today, if oil broke like that, you'd see inflation come down right away. They're both still alive, and they both still think Volcker was the hero. So it's a little bit ironic. And so, and I do think, and I did say in 2008 that lowering rates was going to make things worse because of the interest income channels, and it removed 400 billion, annually with a lag from interest income for the economy, lowering the budget deficit, and that was a negative on the economy. And that we were going to, my tagline has been, because we think we could be the next Greece, we're turning ourselves into the next Japan. Okay, so I just wanted to that's not a universally held position.
So yeah, I mean, and on that distinction, I would focus the difference between affecting demand and affecting inflation, which inflation, administered prices, Gardner means, administrative inflation, cost-driven. So that the distinction, what I would focus on, the important part of your presentation, what you said, important part about Volcker, which I sort of had to, because it was in my epilogue slide and had to sort of glide over it, is that the effect is asymmetric. So the indirect effect that's happening on businesses, I think when you have something like Volcker really shoot up interest rates, is that businesses have to cut somewhere because suddenly they're based on, and it also is dependent on their balance sheet and how much private debt that they have. But when you shoot that up, their debt serving costs explode. So if they're not able to just pass that on, they have to come somewhere, and one of the first places they cut is the capital budget. But the key point there is it's not a direct comparison. They're not comparing the prospective return of those investments. They're just, we have a certain amount of funds that we expect to have in the next year, and we're cutting this one chunk of it. But the key point there is that it's asymmetric. You can increase interest rates a lot and force people to cut their capital budgets, especially public utilities, because they're regulated in a certain way. But you can't lower interest rates a bunch and force them to increase their capital budgets. That's the key point, and that's why it can't really do it as a stabilization policy. And that's the key thing I'm attacking, is the stabilization. That any idea of stabilization policy and interest rates is based on fixed on the natural rate. And once you take that away, even if you can make some case and conditionally in a certain situation that lowering interest rates will increase demand in certain specified situations based on balance sheets, based on it being very high private debt and a very low financial net worths in the private sector, that is not going to be a stabilization policy in the way that a job guarantee or fiscal or certain automatic stabilization fiscal policy is a stabilization policy.
One more thing. As we got into 1979, the inflation, because of the tax structure in the U.S., generated a large fiscal contraction, and I attribute the collapse to that and not to the interest rates, which buffered the fiscal contraction because of the net interest being paid by the government.
You want to take a shot at that too, or do you think we'd be able to that?
I think you've done it very well.
Well, this is a question to Warren. I think this is a very interesting take, linking interest rates with the rate of inflation. But if I think about the general theory in chapter 17 about the money rate of interest and all these things, so if the interest rate goes from 0% to 10%, then of course, if I hold gold, I get 0, and other people who have money get 10. So will not the price of gold go down from $1,300 to about $1,180 as basically as an instant adjustment, so that basically then a rise in the rate of interest will have a deflationary impact? Will this not be the short-term adjustment so that you get to have then a 10% inflation rate?
Okay, so two things on that. First of all, interest income goes up, which is completely a demand side thing. The budget deficit goes up, so it's matched with a fiscal expansion. And as the debt to GDP ratios are higher, like towards where they are today at 100%, that's substantial. So you've got demand pushing up, holding up the spot price. Okay, but what we know will happen is the difference between spot and futures will change, which comes back to the academic definition of inflation. So let's say that adjustment does happen. At that point in time, maybe gold goes to 1,180, whatever, the forward price is still going to be a lot higher, and at that point in time, you know, agents in the economy are going to be facing a term structure of rates that's going up. And so the question is that then the inflation rate at the time, or is it the fact that gold went down in the last period, the inflation rate? What do we mean by the inflation rate? What you see going forward, or what happened yesterday? Okay, I'm not saying that. Now, if you look at what causes that shape to change, if you've got an inventory glut, then the storage costs will tend to go up because demand for storage goes up. But even if they don't, you'll have that upward sloping price. But if you have a shortage, like an oil shortage or any kind of a crop shortage, then the whole thing backwardates, they call it, the interesting word. Like no-see-ums for flies you can't see, we call them no-see-ums. They call it backwardating when the forward rate is lower than the spot. So a bit unsophisticated, but it makes the point. So, you know, and so what happens is if you have a glut, presumably the spot will go down. The spot's already down. The glut price is in a lower spot, and so the idea that forward prices would be higher than otherwise kind of makes sense. Okay, even though it's just storage charges. But if you have a shortage, that kind of implies the spot price is already high because of the shortage, and the forwards will be lower, which is also the dynamic set up by, you know, negative storage costs because you're short. And so that kind of makes sense. So in that sense, the forward prices aren't, just because they're storage doesn't mean they're not mirroring maybe the most likely path, the higher percentage path, although it may never get there. So it's the path from today rather than what happened yesterday. So is the current rate of inflation the path from today, or is it what happened yesterday? That's the question that I'm asking. You know, and that question's never even asked, right?
A quick comment to the gentleman there. You know, yesterday we talked about job guarantee and the effective cost. What was the other term they used? They didn't want to use cost, but yeah. What's that? Expenditure was going to be about $500 billion, which is about 2.5% of GDP. If you now imagine that this is not true, but let's say the total debt was floating rate, right? The U.S. debt, which is about 100% of GDP. If they raise rates from 0 to 5%, that'd be twice the expenditure just on interest, right? So if you think job guarantees were going too expensive, this is what the interest channel can do, is the point, right? Warren, a couple of things. One is, I guess I haven't thought it through carefully enough, but you know, market prices are supposed to reflect not true expectations, but risk-neutral expectations. So I'm not sure what the academic definition is. That the true expected value, or the prices that you can lock in, as it were, certainly for non-perishables.
Imagine having to answer to this guy in your office every day. That's why I'm tossing out what is the academic definition of inflation. I can read it as exactly what I've said, the term structure of prices, or I could read it other ways. The central bank doesn't discuss it. They just report changes in some index proxy of the price level and forecasts some proxy, which we know isn't the academic definition of inflation. Have we now come up with a quantifiable academic definition of inflation that fits the traditional definition? So it's an open question in its definition. It's not right or wrong.
I think what's really interesting about this is that if this is the right definition, then in fact, inflation changes, or expected inflation changes, or this actual inflation changes one-to-one with interest rates, certainly for non-perishable.
Now, if that's the case, here we've had central banks setting policy, changing interest rates on every discussion except this, every criteria except the one that they're actually doing, which is the actual definition of inflation. So they've been doing everything else
In fact,
except that.
counter rate.
Yeah.
If inflation goes up, they raise rates.
Right.
Which should technically.
Yeah,
feed
and
to-
their whole policy has been backwards.
Right.
I can do you first then. We have time.
Hi, I'm Carlos Mucha. I've been talking about stuff like this for years with Warren, and
Good.
it's great to finally meet you. What you're describing, I guess, is the Gibson paradox, that the price level and interest rates are correlated, which is opposite of what central bankers think, that they think it. The New Zealand Central Bank, they had an idea, like 10 years ago, they did go through with it, that I think kind of solved it. What they did, they looked at, instead of raising the policy rate, raising what they called a mortgage interest levy, or an interest levy. So let's say the rates were set at 0, T-bill rate was 0. If they wanted to raise interest rates, they would, let's say they move it to 1%, basically banks, they could either absorb the cost themselves or pass it on to the lender. And so then, instead of the interest rate channel increasing income, it was going to, they were shrinking, what would you call it, draining. They were draining tax money. It would be a 1% income drain. And I wonder if that is, if they did that way, instead of money, if the interest rates channel was redirected to Treasury, would that make interest rate policy more effective, because it's now a monetary/fiscal policy? That's
Okay, well, it might, but first thing is that doesn't answer the question whether this term structure of prices is the quote proper definition, academic definition of rates, of inflation. But, so, what did they do? What did they do?
How it would work is that when they would meet for the idea was, going forward, policy, like the FOMC meeting equivalent, if they wanted to raise interest rates, they would raise the interest levy quarter point a point.
Yeah.
And that would be a tax, that would be a fee that would be applied to loans going forward.
Yeah, so it'd be a cost of funds.
Yes, but it wouldn't, the bank's cost of funds would be the same. They would then pass on the cost to it would be the borrower who would have the higher
Okay, so they'd widen the spread and charge the borrower tax as rates went up. So what they were trying to do as they raise rates is make things doubly bad, I guess. So, because that would remove that income from the economy. It would be a tax. So they combined a rate increase with a fiscal tax.
Right, but the interest rate channel, which if that is what causes, or a reason for the Gibson paradox, by draining money, it would be deflationary. Yeah,
correct.
Which
is what they were trying to do when they raised rates. So have some kind of the inflation offset. Raising rates would be a net payment of interest from Treasury, and the fee would be a net reception of rates. So it's kind of a bit of an offset, so it would cushion that effect. Yeah.
That's
They were thinking to amplify it, but they were cushioning it. Okay, so.
Say the one thing about that is that it's essentially making monetary policy work by just making it fiscal policy and stripping out any remnants of monetary policy.
Yeah, and so when they increased fees for banks, in the last cycle, that was basically an interest rate increase, which was because, you know, that's an interest rate, gets priced in as an interest rate for banks when they, FDIC fees. At the same time, the Fed was trying to lower rates, so they had agencies working cross purposes to each other. And that happens all the time.
Yeah.
Oh.
This gentleman.
Thank you. So Mosler, you raised an interesting question. My definition of inflation is rise in entropy of monetary system. The actual way they define inflation is actually measurement of it. It's not defining it. So I would differentiate between those two concepts. I take this opportunity also to address the debate you had with Professor Kregel the other night with respect to unit of account function of money. I think the issue you were concerned about was the value of product, and the issue that he was concerned about was the accounting mechanism.
No, that wasn't from my point. Go ahead.
Yeah, but that was my understanding of what you were saying, but I might be mistaken. But
Right,
anyway,
right.
let me elucidate what my thinking is on that line. If you consider unit account function of money, that's basically expressing the value of products in monetary units, and that's what prices are. Therefore, if we differentiate between price level and value of product, therefore unit of function, the function of unit of account of money is what it is. So this basically, I don't know whether that makes sense.
So what he would. Okay, so what my understanding, what he was saying is that we should talk about money or whatever starting in the private sector, because historically that's how people think of it. Starting when it did that, he gave an example of credits and debits just at banks before they were making loans. And I said we can't do that, because if we start it in the private sector, we've lost the link to value. We're now just starting with an infinite regression to give it any value, and so we can't use that as our story of how the state currency begins. We can't use it in our state currency story. Our state currency has to begin with a government trying to provision itself, and so it wants to use a monetary system, so it levies a tax and to create a demand for it. And then once it's done that, yes, then it can be leveraged through just credit systems anywhere. So, for example, you have gold futures. There's no gold on the Board of Trade. They're just, you know, debits and credits. It's a system. But you don't trade gold futures if there isn't any gold. And if gold isn't anything, if I just come up with invent a word, you know, ABC, yeah, like Bitcoin, ABC. But if I just invent a word ABC that is meaningless, they're not going to start trading futures on it. Okay, the futures, the derivatives are derived from something. And so we have to start our story. And what I started to also say is the circuit has had that same issue where they begin the story with business borrows money to pay workers. Well, it's not the beginning. The beginning, it comes before that. Why are the workers looking to earn this unit of account? Okay, and so the beginning is the government levies a tax because it's trying to provision itself. And then its unit of account is the thing that can be used to pay the tax. And so now business can hire workers. They see them looking for jobs, so now they can go to the bank and borrow money. So the circuit theory is correct, 100% correct. It just doesn't start at the beginning for the money story. It starts at the beginning for its story, but there's something that happens before that. So for us, we can't start at the level of the circuit theory. We can't start at the level of just credits for what we're talking about. It doesn't work to help explain MMT. And that was my point.
Thank you. I'm just going to generally throw this out there. If I'm reading or hearing this right, interest rates basically don't matter, and they don't affect inflation except for when you raise them, and then that's your term structure. And when we talk about inflation, it's always about prices of goods and services. Just like to hear your comments on like asset price inflation and what interest rates do with that. And then also the question on the capital budget and how it's fixed for most firms. How do interest rates change their ability to access credit to make investment?
Who wants to answer that?
I'll take the last part first.
So on the affects the ability to deal with credit, I sort of skipped over a little bit of that. There's people to look at in terms of the 50s credit rationing story. Richard Russa, I think, is one of the people to look at. And so this was actually the 1950s argument. It wasn't actually about interest rate at all. It was about that if you mess around with monetary policy, you could affect credit. You could indirectly affect basically liquidity preference of banks and affect credit availability. And that's a big issue that does come from the surveys, which I sort of skipped over. Is that it's credit availability at all, not the terms, that affect the certain firms from being able to make an investment decision. I would say that in general, interest rate policy, it is traditionally approached, I don't think really messes with credit availability, except that certain borrowers become uncreditworthy at much higher interest rates. I think this is actually a lot more important for like 19th century issues, where there's a lot more uncertainty about just any basic information about a borrower's income. If you look at like before the Civil War, kind of antebellum banking and stuff. But in general, I would say that the effect of interest rate policy, it's much more regulatory policy that deals with credit availability than interest rate policy. And then the first part.
Well, let me just add, what I'm saying is, I took notes for them, the nominal rate equals the real rate in my model. And in fact, we've observed that, we had what were supposedly very low real rates, and then the rate of inflation came down to the nominal rate. It wasn't the other way around. We saw that under Greenspan, where he raised rates, and then the rate of inflation came up to the nominal rate. And so I'm just saying there's some evidence of this connection where the nominal rate is the real rate, and that's where the adjustment takes place.
Surely, Warren, you mean the real rate's zero?
Is what?
The real rate is zero if the rate of inflation.
Not the real rate. I'm sorry. Yeah. Right. So the real rate is zero. That's what I meant.
So really,
I misspoke there. Yeah.
Without knowing it, setting the zero real rate.
Yeah. So as I set the inflation rate, they're always setting a zero real rate.
Yeah.
Because their rate is the rate of inflation. Right.
Yeah.
Nice. I misspoke.
I disagree there because I think the changes are coincident. It may not the real.
Well, I'm just throwing that out. That in my model, the real rate is always zero.
No, because of storage costs.
Yeah. Okay. But I can argue that that's part of the definition, but we'll do that. Okay. Now, I just want to make another point about the difference. Most of those things you're talking about were in fixed exchange rates regimes, and so gold standard type of thing.
Well, I did the later surveys was all that.
No, the theory.
Oh, the
Excel,
Oxford economy.
Yeah.
Oh, yeah.
Okay, so under fixed exchange rates, investment causes the interest rate. So when you have high demand for funds, you drive up. It's all about available funds, and you're driving up the rates, and then you're competing for them, and so the high rates have the appearance of then choking off the investment, but it could never happen because there's only so many vulnerable funds in bank reserves, so they're competing. And so you've got to, when you get to floating exchange, that doesn't happen. Then the whole thing's different. So you got to be a little careful when you're looking at fixed rate versus floating rate investment interest rate type relationships. Okay. And I think, I called Chairman Volcker the Donald Trump of Fed chairman. He's trying to target non-borrowed reserves. This is just insane. But that was, I don't know how many of you lived through that, watching it on a day-to-day basis, but it was embarrassing to be an American watching this guy do that stuff. Okay, that's it. Great.
I'm sorry, we're now out of time, so that's it. If you can ask them, you can come to the podium. Thank you.